Welcome to my office, where we get to have a bit more of a casual chat about the markets, economy, pretty much anything I want. And today I want to talk about timing. Now, something you've probably heard before is that time in the market beats timing the market. And that's probably one of the biggest loads of horseshit you'll ever hear. Well, I mean, if you're 20 years old and you have absolutely no interest in learning anything about the markets, then, sure, you have time on your side. But in addition to timing, you also have being in the right asset class. And take crypto as a perfect example. If you bought Bitcoin, you got sucked into the hype in Bitcoin back at the end of 2021, it's right around the same place, or actually it's at exactly the same price as it was back then at $69,000. So not only have you not made a return on your money, you have also just had a massive opportunity cost where 4.5 years your money has sat idle. It would have made more money in the bank. If you're invested in the stock market, you would have seen something like a 40% return in that same time, plus dividends, because remember, stocks actually, produce some kind of revenue, and gold is up something like 150% in that same amount of time. So don't let anyone tell you that time in the market beats timing the market, because time is everything. And we are now at a very important time juncture when it comes to economic cycles, the economy, real estate, everything. And I'm sure many of you will have heard me talk about before how we're more likely at the end of a major economic cycle, real estate cycle, credit cycle, whatever you want to call it. But we've basically been in an expansionary phase now for the last 15 to 20 years, depending which asset class you are looking at. And in terms of timing, we are more likely at the extreme precipice of the cycle as opposed to expecting this thing to just keep on going. Now, there are a lot of markers to suggest that, specifically in the real estate space, and real estate is critical because it's the biggest asset class in the world by a factor of something like 10. In Australia alone, we're at around 11 to 12 trillion dollars of real estate value. In the US, the numbers vary, but it's something like 50 to 300 trillion, depending whether you're including commercial real estate or not. But we're talking in the tens of trillions of dollars as opposed to just a few trillion dollars here and there in different asset classes. So following what the land and real estate market is doing is absolutely critical. And we're seeing a number of indicators to suggest we're more likely at a top or very close to it as opposed to expecting further expansion. Now, there are many metrics and data points that I track, but just to name a couple of them, we're now seeing the largest amounts of real estate selling at a profit since 2005. And that timing should spark your interest because 2005 was just a couple of years before we got to the peak and the global financial crisis. This time I expect the downturn to be significantly more severe because we have many more systemic issues, but that's another story. But in terms of metrics suggesting we're more likely at a peak, we're starting to see real estate sit on the market for the longest time in about 20 years. In the US, properties are sitting on the market now for 66 to 69 days, up on the last 12-month period. We're starting to see asking prices get decreased as opposed to increased, showing that we're moving into a buyer's market as opposed to a seller's market, which has certainly been the case now for many, many years. In addition to that, we are seeing the highest levels of investor loans at all time, because if you think about it, investors are pricing in future gains, thinking that if I buy now, I'm going to be seeing a 10%, 20% return on my property in the coming years, because that's what it's done over the last few years, just showing the real recency bias. And a recency bias is when people put too much weight on what has happened in recent times as opposed to zooming out and looking at some bigger picture analysis. But all this is to say that timing is critical. We're at the time juncture for a major top, but these things can still take a bit of time because we're talking about bull markets that have been going on for 15 to 20 years. So it won't necessarily just stop on a dime and crash. Tops are a process. I'd encourage you to go back and watch a couple of my other videos where I break down some of the issues and how I think it's going to be a rolling series of crises before the entire economy takes a turn and feels the pain. And not only that, you can take a look at my main channel where I just pull apart the charts and analysis, looking at positioning and the flow of money. I'll link that down below, but I'll leave it at that for this video here. Wishing you more health, wealth, and happiness. And until next time, I'll catch you then.
Hey yo, hey yo, hey yo, hey yo.